Welcome to the SME Business Toolkit podcast, an initiative by the French-New Zealand Chamber of Commerce and Industry.
Bonjour, mon nom est Thibault Beaujot. My name is Thibault Beaujot and I'm the General Manager of Paneton Bakery. That's a business within the FMCG industry. We make French pastries, French bread that we mainly sell into retails that you can find in the stores like Faro, Woolworths and the foodstuff banners such as New World. Today, as many other businesses, we face another unprecedented situation. Seems to be a trend for the last few years, which creating challenges in each and every business, and we are one of them. Today I've got a couple of questions that I would like to ask our experts for advice on. With the cost of all ingredients and the cost of petrol going up, all our costs in terms of making a product and bringing the product to our partners and retailers that sell the product to the end consumers are affected by a lot of different factors within which could be the cost of the ingredients, cost of packaging driven by fuel, and the cost of supply chain. My questions are, number one, I've got actually two. Shall we as a business always transfer the cost increase of running our business or making our product to the end consumer? And my second question is, what is from your perspective the best way to manage cash flow in such a situation? And the impact it has on our business, knowing that most of our partners are actually in the same boat, and we need them as much as they need us. Thank you so much for your answer. Merci beaucoup, and I'm looking forward to hear from you.
We just had two very real questions that a lot of business owners are facing right now. To help us answer them, I'm joined today by Kaison, Associate Director at BDO Auckland, and Sébastien, Founder and Managing Director of HSCM. Welcome to you both. Could you each take a moment to introduce yourself and tell us a little bit about what you do?
I'll start. Thanks for having me. Yeah, so as mentioned, my name's Kaison. I'm an Associate Director at BDO in Auckland, and I work with our business advisory team here. My focus is around helping businesses, typically owner-managed businesses and high-net-worth individuals, with everything from their day-to-day financial management through to more strategic advisory work. A lot of what I do comes down to helping clients make sense of their numbers and use them to make better decisions, which I think is very relevant for this topic.
Yeah, so I'm Sébastien Malleville. I'm founder of HSCM Solutions, it's a supply chain management boutique. So I've spent 20 years working in the supply chain field across Europe and New Zealand. And basically I help importers, distributors, manufacturers improve their procurement, freight, inventory. So it's basically I help them identify where their costs, their cash, and inefficiencies sit through their supply chain. And I try to turn this into a competitive advantage.
Okay, thank you. So before we get into the specifics, from where each of you sit, how widespread is this cost pressure right now? Are the businesses you work with all feeling it?
Universally, the answer to that is yes. I don't know if I've spoken to any client in the last 12 to 18 months where cost pressure hasn't been an issue. And, further to that, it's been across all sorts of sectors as well, whether that's hospitality businesses, food and wage cost pressure, obviously the construction industry where margins are being squeezed there, all the way through to professional services where, managing overheads at the moment is also getting tricky. So everyone's feeling it.
Totally agree. And obviously customers in New Zealand are feeling this, but definitely the pressure is global, from raw material, energy prices, freight, labor, interest rates mainly also in New Zealand. So this is a new normal, I would say. And need to adapt to it. The ones that are struggling right now, that are definitely the ones that are less prepared. So the more prepared you are, the less struggle you will face.
So now let's dive a bit deeper and take the first question that Thibault raised. Should a business always transfer its cost increases, whether in production, packaging, or delivery, onto the end consumer? Kaison, you work with businesses and high net worth individuals on their finances every day. So let's start with you again.
I mean, obviously, I'm looking at it from a very accounting perspective. So I guess the first thing I would always do before making those sorts of decisions is look through to the actual numbers and data to get a clearer picture of where things are sitting before making a decision like that. It is always kind of horses for courses depending on the client and the environment that they're working in. So from my perspective, it's about getting clarity on that picture first before making those decisions.
Like from an accounting perspective, does it matter whether a cost increase is temporary? Like, for example, the fuel spike we saw like a couple of weeks ago versus something more structural and long lasting. Does that change the advice you would give?
Oh, you're right. So it absolutely changes the advice that we give. And it's one of the most important distinctions to make. If a cost spike is generally short term, say, for example, a temporary supply disruption or the fuel prices you've mentioned, and history suggests that's correct, and I guess the conversation about whether you have enough liquidity to absorb it without passing it on, because pushing a price increase through and then having to roll it back damages, it has the ability to damage customer relationships. But if the cost is structural, if there's new labor cost floor with wages, for example, any permanent changes to input pricing, then you have to reprice your product or service, because absorbing it obviously permanently destroys the business. I guess the risk I see is that businesses kind of convince themselves that something is temporary when it isn't, because the conversation about repricing is uncomfortable. That's where the numbers, again, like I say, they need to be properly looked at so you have clarity around that decision making.
Now, I would like to bring in your perspective, Sébastien. You work end-to-end across supply chains, forecasting, procurement, inventory. When costs go up across all of those areas simultaneously, where does a business typically have the most leverage to push back before it even gets to a pricing decision?
So for pricing decision, for supply chain point of view, definitely increase pricing shouldn't be the first lever, should be potentially the last one. But as Kaison mentioned, there are some opportunities where obviously you can't absorb all the cost if they are structural. What I noticed is most businesses, they still have some opportunity in their own operations to absorb part of their costs. What I mean absorb is reduce their own costs, so they are able not to pass on to their customers. Definitely a lot of areas where they can look at. I will note three. The first one will be the suppliers, so they can improve their payment term with their suppliers, better rates. We can consolidate better their container, or we can deal with volume rebates with their suppliers. The second area would be freight. So I think this is a big expense for New Zealanders, mainly for importers, obviously. So what I've noticed is most of my customers didn't really benchmark the market for years. So here we can definitely find good savings, potentially between 10-20% savings in some cases on landed cost. And the third one, that is more related to cash tied, is inventory. So a lot of businesses hold or too much stock or not holding wisely their stock. So again, try to work on how to reduce their spend on supplier and freight, as well as liberating some cash from inventory.
Thibault mentioned that most of their partners are in the same boat. Do you think that this mutual dependency changed the equitation when it comes to passing on costs?
There's so many different factors going on at the moment that it kind of makes everyone along the supply chain be affected. And so everyone is feeling these cost pressures, and often, getting back to Thibault was saying, communication around these sort of, these types of conditions is really important. So it affects the conversation in a couple of ways. On one hand, there's almost this collaborative kind of structure when everyone in the supply chain is facing the same pressures. So structurally, price adjustments become a little more accepted and less likely to damage relationships because the customer or partner knows, what everyone else is dealing with. On the other hand, however, it can kind of create a timing problem. If everyone is trying to pass on costs simultaneously, at some point, someone in the chain has to absorb those cost pressures. And it tends to be whoever has the weakest negotiation position. So I guess the question becomes, where do you sit in that chain and how do you use that position wisely?
One positive thing of having all the actors of the market, like supplier, provider, customers, is that now they really need to work together. When it was just one raw material increase, the producer will have to absorb it or try to pass onto his customer. But now they are all suffering the same challenges. So I think the approach is a bit different. It's more collaborative. It should be more collaborative and just try to pass on cost to someone else. Question will be more, how do we manage this cost increase together rather than who is taking the cost?
Okay, thank you. I think it also really goes hand in hand with the other question I had. This was about, what do you think, how transparent should a business in such a case be to their partners, but also their customers when prices go up? So whether it's more like a risk or does it actually help?
Yeah, from what I'm seeing in the market, generally transparency and good communication has helped because everyone's in the same boat. But obviously, it has to be specific. So, for example, saying something like our costs have gone up is not very compelling, but being able to say, hey, our costs have gone up because our packaging costs have increased by this, our freight bill has doubled, et cetera, et cetera. It's a very different conversation. And I guess giving the specificity builds credibility, and it also signals to other parties that you're working with that, you're across the business, drivers, and you're genuinely wanting to be collaborative rather than just doing a widespread, my costs have gone up.
Thank you.
Totally agree with Kaison. If the prices are justified and they are clearly identified, the conversation is easier. And one thing I would suggest is also to have all those drivers put on a contract. So it's less reactive and it's more, we know that our product is subject to this kind of increase, could be raw material, freight, energy price, clearly set up somewhere in a commercial document.
All right, thank you so much for these insights. I think we are on the same page. For now, then, I would like to jump to Thibault's second question. What is the best way to manage cash flow in this kind of environment, especially when your partners are under the same pressure? Sébastien, let's start with you this time.
Well, cash flow is not one company issue. It's a whole supply chain issue from the supplier to yourself, to your providers, to your customers. And I think it would be all around communication. Just make sure we have the best term as possible with your suppliers. So make sure that you take advantage of them to finance part of your, basically that you pay your supplier after you receive the money from your customers. I would say would be ideal. The other one would be obviously to try to liberate some cash flow through inventory management, better procurement processes, by definitely just what you really need to have to hold on stock rather than fear of the future and buy too much, or fear of the future and don't buy enough and you deteriorate your relationship with your customer.
Do you want to add something on that, Kaison?
Yeah, obviously Sébastien is more the expert from a whole supply chain perspective. I guess where I can add value is at the business level. It comes back to building in the resilience and having structures in place to kind of help with that resilience and preparation. So I would always encourage businesses to have a rolling cash flow forecast. if possible, 2 to 3 months out. It doesn't need to be that sophisticated. It just needs to show, what's coming in, what's going out, and when. And getting back again to what Sébastien was saying, most businesses that actually run into cash trouble, it's not that they're unprofitable. They're very profitable on paper, but they've got the timing of the cash flow wrong with, when they're paying suppliers versus receiving funds from customers. So forecasting that out by 2 to 3 months to kind of show you where any gaps may be, and it gives you the ability to kind of prepare yourself to mitigate that cash flow risk. And I know in a situation where you don't have much resource, it's easy to kind of not do it. But I would strongly encourage setting some time aside, even if it's the business owner themselves.
I would like to come back to you, Sébastien, and about the cash flow, because you work with businesses under supply chain operations. And what would you say is the moment you realize that cash flow is actually the underlying problem and not just an operational one?
When companies start buying less but when they need, start getting some, for example, air freight, some goods they don't have in stock, or they start discounting products just to get cash, or paying supplier late. So you really notice that, when you are in those situations, you can definitely see that the impact of the cash flow on the operations. And it's cash with driving operation. This is never good for service, I would say. I mean, obviously, from supply chain point of view, I would prefer that supply chain is driven by demand, but I know there's also this finance components, but definitely the more weight the finance has on the decision of operation, the worse understand this bad finance situation that bring those decisions.
Thank you for clarifying that again for our listeners. You talk about supply chains as a competitive advantage. I saw it on your LinkedIn, for example. Can this cost environment actually be an opportunity for some businesses to pull ahead rather than just survive?
So I would say, well, they have the choice or keep going as they do and struggle, or obviously take advantage of all those challenges to revisit their weaknesses. Most of the time, like those cost pressure, they expose the companies to react. But in fact, it's, like crisis is also means opportunities. So I would say it's the right moment for them to review supplier terms, freight costs, logistics, if everything fits for purpose. But sometimes people want to do more than they should and spend more money that they really need to spend. Although I know it's difficult for companies and they are struggling, but it's definitely the right opportunity for them to revisit how they are doing things, improve their processes, cut costs where they don't need to spend more. And it's all about, discipline. So basically, rather than go to survival mode, it's more on how do you adapt faster and gain control of everything. And it's where you bring this competitive advantage.
I would like to come back to you now, Kaison. Would you say there are financing tools like, for example, working capital facilities or other structures that businesses should be using right now, but often are not?
A lot of business owners, they'll often think of the supply chain as just being their core product or service. As a business owner, you need to think about it more widely and include the bank and even the IOD, for example, in those conversations. When cash flow becomes an issue, often it's the bank and the IOD that kind of get put to one side. Early and good communication with both is always a good way to help manage cash flow. Most banks will want to be helping their customers, and they'll often have bank products like a revolving credit facility or overdraft to kind of help clients manage these pressures. Similarly, with the IOD, if you go to them early about not being able to pay a certain tax type on time, you can come up with a payment plan with them.
We just talked about communication again, and we also touched mutual dependency between businesses and their partners a while ago when we were discussing the first questions. So how would you say does this dynamic play out specifically when it comes to cash flow? So like the dependency between businesses and their partners, and is it a constraint or something you can actually work with?
See, everybody is interconnected. So it's basically, I would recommend just to work closely with your suppliers, your providers, your customers. Although with retail, it'll be more difficult to discuss with customers. You need to plan accordingly with them, try to find solution together. Obviously, your supplier would definitely like to help you because it doesn't want to lose you. And your customer obviously also need you because they want to keep buying your products. So I think it's all about how you connect all together, you plan properly, how we can reduce cost in the logistic field together, improving the planning, improving forecasts, improving frequencies, all these kind of things. So everybody can free up some cash and in the benefit of everybody. So again, it's collaboration, planning. Let's make this work together. Better to have good communication now or even earlier through commercial contracts when everything is under pressure and where the communication is definitely more difficult to have.
What's the most common mistake you see businesses make when they start feeling the cash squeeze?
The most common mistake without fail that I see, I mean, other than the preparation thing that you mentioned, is just waiting too long to address the problem. For sure, that's probably the single most consistent pattern I see. They, even though they haven't got, say, a structured forecast in place, business owners will often be, have their ear close to the ground, and they'll kind of have a feel for the business, and I guess they'll feel those early warning signs. Usually it's something like slower, customers paying slower or getting behind on tax payments, that sort of thing. And instead of kind of confronting the problem head on, they kind of think that it'll resolve itself next month. So that, by the time they go to their bank or whoever it is, the options have dwindled down because they've left it too late to address the problem. The businesses that manage the cash well in tough conditions are definitely the ones that address the problem early and act quickly.
Sébastien, do you have anything to add to this?
One common mistake, I would say, is sometimes people, they don't really know where to start and they try to do a lot of things at the same time. To just target one area of the business, it could be a quarter, focus on 3 months projects, just focus on how do we reduce the inventory, or how do we reduce freight cost drivers? Just focus on where really you can make a bigger difference.
So we are almost coming to an end of this episode. Before we close out, I would like to leave every business owner listening with one thing, whether that's a mindset shift, a conversation to have, or something practical to do. What would it be? What would you recommend?
Know your numbers. Specifically, know exactly what your business needs to bring in each week to cover its obligations, wages, rent, loan repayments, etc. And remember that break-even cash point can be different from your account break-even. A lot of business owners don't have that number, in their head, which means that, without it, you can't make fast, confident decisions when things get tight. So preparation, communication, and know your numbers.
Sébastien, what would be your advice?
Pick one area in your business, focus on it, try to make the most savings or more efficiently what you need to achieve to keep with the service. Companies that are proactive on a day-to-day and don't wait for the problem to arise are the ones who are definitely safer, I would say.
And that's a wrap on today's episode. A huge thank you to our guests for sharing their expertise on supply chain and cash flow, 2 topics that sit at the heart of every SME's day-to-day reality. And thank you too for listening. If you'd like to dive deeper, we've put together a written one-pager with all the key information and content details from this episode. You'll find it on our website, so make sure to check that out. Until next time.